Ever felt like you're leaving money on the table when it comes to your taxes? Just because, well, you don't fully grasp the IRS's language. What if I told you that understanding just two uh, seemingly technical terms, basis and holding period, could unlock significant tax savings and maybe prevent some costly mistakes? Today, we're not just talking theory. We're diving deep into the surprisingly powerful world of how your assets are valued for tax purposes. This is where real financial clarity and real tax optimization really begins.
That's exactly right. So many people jump straight to, deductions and write-offs, but the true foundation, I mean the bedrock of every single taxable gain or loss you'll ever encounter, it lies in truly understanding an asset's basis. It really is the starting line for all your tax calculations. Get that wrong, and, well, everything else can kind of unravel. This deep dive will unpack the core principles behind how the IRS calculates the value of your property. Doesn't matter if you bought it, received it as a gift, inherited it, or even converted something personal for business use. Our mission is really to transform these complex rules into clear, actionable insights, helping you see precisely where those hidden tax opportunities and, yeah, unfortunately, some expensive pitfalls truly lie.
Okay, so we'll explore the distinct tax journeys properties take depending on how you get them. We'll look at how buying, receiving, or inheriting property dramatically impacts its tax future. That sounds crucial. We'll untangle the nuances of business expenses too, and even touch on how converting personal items for business use can have a surprising tax angle, something you definitely need to know about. So if you've ever owned anything or plan to, and let's be honest, that's pretty much all of us, this deep dive is custom tailored for you. Okay, let's unpack this foundational concept then. Basis. When we buy something, our instinct is just, the cost is the price tag. Simple. But for tax purposes, basis is far more comprehensive. It sounds like it's more than just what you hand over at the register. What exactly goes into this initial basis, especially for something tangible you purchase?
Yeah, what's fascinating here is that the initial basis isn't just the sticker price. It's a much broader idea. It encompasses all the amounts you pay to acquire the property, prepare it for its intended use, and, ultimately place it into service. Think beyond just the direct sale price. This means you need to factor in critical, often overlooked costs. For example, say you purchase a piece of heavy machinery. Well, the shipping costs to get that equipment from the vendor to your facility, that's part of its acquisition cost. Then, once it arrives, there might be significant installation costs. A piece of complex equipment isn't really in service until it's properly set up and maybe even calibrated. And don't forget sales taxes. These are a direct cost of acquisition, not some separate expense you just deduct elsewhere. And in some specialized cases, like for industrial or high-tech equipment, you might have testing costs to make sure it functions correctly before it's truly operational in your business. All of these add up to the initial basis. And this comprehensive approach is incredibly important because a higher initial basis directly impacts your future when you sell the property. A higher basis means a lower taxable gain or maybe a higher deductible loss, which directly reduces your tax liability. It's like literally the starting point for saving money down the road.
Okay, so if I'm tracking this, it's not just the sticker price, but every single dollar you spend to actually make that asset usable in your hands. Can you give us a concrete example of how this plays out financially? Make it real.
Absolutely. Let's take that piece of equipment for your business again. Let's say its advertised price is $5,000, but then to get it to your facility, you incur $500 for shipping. Seems reasonable. And to get it installed and ready to work, you pay another $200 for professional installation. Okay, so your initial tax basis isn't just that $5,000 you paid for the machine itself. Instead, it's $5,700. That's the $5,000 purchase price plus the $500 shipping plus the $200 installation. Now, here's the so what, the important part. When you eventually sell this equipment, let's say for $6,000, your taxable gain will be calculated against that $5,700 basis. So your gain is only $300. If you had mistakenly used only the $5,000 purchase price as your basis, your gain would have looked like $1,000, significantly higher. That's $700 difference. That translates directly into real tax savings for you. And it's critical to understand this principle applies broadly, both to real property like land, buildings, and personal property, which is pretty much everything else, right? Your computer, manufacturing machinery. The fundamental calculation for initial basis remains the same across these categories.
Okay, here's where it gets really interesting for me. Basis isn't static, right? Things wear out. They become obsolete. What happens with depreciation? How does that process, accounting for wear and tear, actually impact an asset's value for future tax calculations? I mean, a machine might be worth less over time, sure, but how does the IRS account for that in its tax value?
Yeah, that raises a really important question. How does using an asset in a business affect its tax value over time? And you're absolutely right. Basis isn't static. It's a dynamic figure. It changes. It's reduced by the amount of any depreciation. And this is key. Whether you've actually claimed it on your tax return or were simply allowed to claim it under the tax law, this new adjusted figure is known as adjusted basis. And that's what you use when you eventually sell the asset to figure out your taxable gain or maybe your deductible loss. Think of it like this. Depreciation is the IRS's way of letting you recover the cost of an asset over its useful life through those annual deductions. By reducing the basis, the tax code ensures you don't effectively double dip on your deductions. You can't deduct it annually and use the full original cost when you sell. It's a way of accurately reflecting the asset's true remaining value for tax purposes. It guides every future transaction involving that asset.
So it's like the asset's tax cost basis is constantly evolving, reflecting the deductions you've already taken. Can you walk us through a practical example? With numbers, how does this actually work?
Certainly. Let's go back to that milling machine we mentioned earlier. Initially purchased for $10,000. In year one, your business claims, let's say, $1,000 in depreciation for that machine. In year two, you claim another $1,000. Okay. So by the end of year two, your total accumulated depreciation on that machine is $2,000. At that point, the machine's adjusted basis isn't its original $10,000 cost anymore. It would be $8,000. That's the $10,000 initial cost minus the $2,000 in accumulated depreciation you've already deducted. This $8,000 then becomes your new starting point for any future sale calculations. So if you were to sell the machine for, say, $9,000 at the end of year two, your taxable gain would be $1,000. That's the $9,000 sale price minus the $8,000 adjusted basis. It wouldn't be zero based on the original cost. This adjusted basis is a crucial figure because it accurately reflects the tax benefit you've already received from the asset. Ignoring it could lead to significantly understating your taxable gain or maybe overstating your loss. Big mistake either way.
Okay. Now, I've heard about stock splits and stock dividends. They often seem like you're getting free money or extra shares as an investor. But from a tax perspective, how do those affect my cost basis? Does it just dilute my original investment or change it somehow for tax purposes? And what's the implication for when I eventually sell?
Right. If we connect this to the bigger picture of investing, they are often perceived as free shares, like you said, but there's a specific and really crucial tax consequence for basis that every investor needs to understand. When you receive a non-taxable stock dividend or you go through a stock split, it actually doesn't change your total cost basis in that stock. Your overall investment value, from a tax perspective, stays exactly the same. However, and this is the key, you are required to spread your original total basis over both your original shares and any new shares you receive. So this process, by increasing the number of shares you own while keeping the total basis constant, results in a lower basis per share. The logic behind this is pretty simple. The total economic value of your investment hasn't actually increased just from the split or dividend itself. You simply own more pieces of the same pie, essentially. The IRS wants to ensure that when you eventually sell any of those shares, the proper amount of gain or loss is recognized, and that means adjusting the per share basis downwards.
So it's like slicing a cake into more pieces. The cake itself isn't bigger, you just have more slices, and each slice is proportionally smaller. That makes sense. Can you give us an example of how this calculation works and why it matters so much?
Precisely. That's a great analogy. Imagine you initially purchased 100 shares of some company's stock at $11 per share. Okay, so this gives you a total cost basis of $1,100 for that investment. $11 by $100. Now, let's say the company issues a 10% non-taxable stock dividend, so you receive 10 additional shares. You now own 110 shares instead of the original 100. Your total cost basis for the investment, however, remains $1,100. It doesn't change. So instead of having a basis of $11 per share, that $1,100 total basis is now spread across all 110 shares. This means your basis per share drops to $10. $1,100 total basis divided by 110 shares. And this lower per share basis is absolutely vital to remember for future capital gains calculations when you eventually decide to sell any of those shares. If you sell some shares later, that $10 per share basis directly impacts your taxable gain. It could potentially increase it compared to if you incorrectly assumed your per share basis stayed at $11. It's a subtle but really significant adjustment. Misunderstanding it can lead to underpaying or, maybe worse, overpaying your capital gains taxes.
All right, let's move beyond things we buy ourselves. What if someone generously gives you property? Like, say, a parent gives you a house or maybe a valuable piece of art. How does that impact your tax situation when you eventually sell it? Do you just get their cost basis, or is there more to it? This feels like it could be a potential minefield, or maybe an opportunity.
Oh, that's a great question. And it's where the tax rules get particularly interesting and, yeah, sometimes quite complex. The general rule for property acquired as a gift is that you effectively step into the donor's shoes from a tax basis perspective. This means you typically take on their rollover cost basis. In other words, the property generally retains the cost basis it had in the donor's hands at the time of the gift. So if your parent bought that house for $100,000 years ago and they gift it to you today when it might be worth much more, your starting basis for that house for gain or loss purposes is generally still that original $100,000. Now, there's a little detail worth noting. The basis can be increased by any gift tax paid that is specifically attributable to the net appreciation in the value of the gift. That's a bit niche, but possible. But the core concept is you generally inherit the donor's tax history with that asset, which, can be a benefit or a burden depending on how its value has changed over time.
Okay, so if the asset has appreciated significantly while the donor owned it, you inherit that lower basis, meaning you'll recognize a larger gain when you eventually sell it. Ouch. Can you give us an example of how that plays out?
Exactly. Let's consider an example for a gain scenario. Suppose a donor gives you some non-depreciable property, maybe a valuable piece of art or a parcel of land that had an adjusted basis of $5,000 in their hands. They bought it for $5,000. Now, at the time they gifted it to you, let's say its fair market value was only $3,000. So it had actually declined in value since they bought it. However, you hold on to it, and later you manage to sell it for $6,500. Good for you. Now, for purposes of determining your gain, the IRS uses the donor's original $5,000 basis. This means your gain will be $1,500. $6,500 proceeds minus the $5,000 basis. That initial drop in value from $5,000 down to $3,000 when it was gifted, it's completely irrelevant for gain purposes if your selling price ultimately exceeds the donor's original basis. You essentially pick up where the donor left off in terms of their potential gain, even if the value dipped temporarily. This can definitely be a pitfall if you're not aware of that original lower basis. However, this is where it gets truly nuanced, and it's a really vital lesson for anyone thinking about giving or receiving property. What happens if the fair market value, FMV, on the date of the gift is lower than the donor's rollover cost basis? This is the situation we just touched on. In this specific situation, the basis for you, the done, actually depends entirely on your future selling price. It's not a straightforward rollover anymore. Why? Because the IRS wants to prevent people from simply gifting property with built-in losses to someone else who can then deduct that loss. They want to limit loss transfers. Okay, let's break this down into specific scenarios. It helps. First, if you sell the gifted property for less than that lower fair market value at the date of the gift, meaning you're clearly selling it for a loss compared to its value when you received it, then your basis for purposes of determining that loss is that lower FMV at the date of the gift. For example, using our previous property, if you received it when it was worth $3,000, even though the donor's basis was $5,000, and you then sell it for only $1,000, your deductible loss is $2,000. And that's calculated using the $3,000 FMV at the date of the gift as your basis, not the donor's original $5,000 basis. The $5,000 basis is ignored for loss purposes because the value had already declined before you even received it. The IRS won't let you deduct the donor's loss. Now, whether that $2,000 loss is actually deductible on your tax return depends on other rules, like what type of property it is, but the basis calculation for the loss itself follows the specific rule.
That makes sense for a clear loss situation. But what about that tricky in-between scenario you mentioned, where the sales price falls somewhere between the donor's original basis, $5,000 in the example, and the lower fair market value at the time of the gift, $3,000? This sounds like that no gain or loss zone I've heard whispers about. Is this where a hidden opportunity might lie? Or just confusion?
This is indeed the most fascinating part, and it's a critical detail that, honestly, many people completely miss. If you sell a gifted asset for a price that is less than the donor's rollover cost basis, $K, but simultaneously more than the lower fair market value at the date of the gift, $30, neither a gain nor a loss is recognized for tax purposes. It's precisely termed the no gain or loss zone. It's like a tax twilight zone. In this very specific scenario, your basis for that particular transaction effectively becomes the selling price itself, whatever you sold it for. This is crucial knowledge for anyone thinking about selling a gifted asset, as it can completely change the tax outcome. You might assume you have a small gain or maybe a small loss, but because of this very specific rule, there's absolutely no tax impact at all, zero. It can feel like a strategic loophole, maybe, but it's just the rule. Definitely something to be aware of.
Wow, that's incredibly nuanced and powerful. So if I understand correctly, let's use that painting example. My aunt bought it for $5,000. She gives it to me when it's worth $3,000. And then I sell it for $4,000. Since $4,000 is between $3,000 and $5,000, I literally pay no tax and deduct no loss. It feels almost like magic. So what's the simplest passkey or takeaway to remember this three-tier approach? It's a lot to juggle.
You've got it exactly right. It does feel like magic sometimes because it defies our normal intuition about gains and losses. To put it simply, think of it with this handy passkey summary. If you sell higher than the donor's basis, use the donor's basis to figure out your gain. Simple enough. If you sell lower than the fair market value, FMV, at the date of the gift, use that lower FMV to figure out your loss. And crucially, if you sell between those 2 points, less than the donor's basis, but more than the FMV at the date of gift, there's no gain or loss recognized. Boom. Nothing happens tax-wise. Your basis just becomes the selling price for that specific transaction. This is a really powerful piece of knowledge for tax optimization when you're dealing with gifts. It lets you anticipate the tax consequences of a sale with much greater accuracy and make informed decisions about when, or even if, to sell a gifted asset.
Okay, and if you're depreciating a gifted asset, say you received a building as a gift and now you're using it for your business, does that same complex rule about gain and loss, with potentially different bases depending on the outcome, apply for depreciation purposes? Or is that handled differently? Please say it's simpler.
No, thankfully, it is a bit simpler for depreciation purposes. Assuming the gifted property is eligible for depreciation, like a building or machinery used in a business, regardless of the potential basis for gain or loss on sale, which, as we just discussed, can be variable and you might not even know it when you start depreciating. The basis for depreciation is always the lesser of two figures, either the donor's adjusted basis at the date of the gift or the fair market value of the property at the date of the gift, whichever is lower. This lesser of rule is designed, again, to prevent taxpayers from depreciating a loss in value that happened before they even owned the property. This amount is what you use to calculate your annual depreciation deductions. Then, of course, this depreciable basis is reduced by any accumulated depreciation you take. And that adjusted depreciable basis will then be factored into determining the actual gain or loss when you eventually sell it later. So it's really important to keep these two different basis calculations separate in your mind. One specifically for annual depreciation and a potentially different, more complex one for calculating gain or loss on sale down the line.
And does the holding period matter here? When you get a gift, is it always counted from when I receive the gift? Or does the donor's history with the asset come into play somehow? That could dramatically affect whether it's a long-term or short-term capital gain, right? Which means different tax rates.
It absolutely matters, and you've hit on another crucial point that can significantly impact your tax bill. Generally, you, as the recipient of the gift, assume the donor's holding period. You get to tack on their time. This is often very beneficial because it allows you to potentially qualify for the more favorable long-term capital gains rates much more quickly. For instance, if the donor held the property for 5 years and then you hold it for just 6 months before selling, your total holding period for tax purposes is considered 5.5 years, instantly qualifies for long-term treatment and those lower tax rates. However, there's always a however in tax, isn't there? There's an important exception to remember. If the fair market value at the time of the gift is used as your basis for determining a loss, remember that loss basis scenario we discussed where the FMV at the time of gift was lower than the donor's basis, in that specific case where you're using the FMV to calculate a loss, then your holding period for that specific calculation starts as of the date you received the gift. The tacking rule doesn't apply for that loss calculation. This distinction ensures the tax treatment is consistent with the basis rule for losses. It's another key detail to remember for complete tax accuracy and, potentially avoiding higher short-term capital gains taxes.
Okay, wow. Gifts are complicated. Now, inheriting property, that's a completely different ballgame, right? I've heard about something called a step-up in basis, and it's often mentioned as this huge advantage for heirs, a cornerstone of estate planning. What exactly does that mean? How does it work, and why is it considered so powerful for tax savings?
Indeed, this is a very significant advantage for heirs, and yes, a common and powerful tax planning strategy, arguably the single most impactful one for passing appreciated assets across generations. Property acquired by bequest or inheritance generally takes as its basis the step up, or, in rare cases where value dropped, a step down to the fair market value, FMV, at the date of the decedent's death. This is fundamentally different from how gifted property is treated, where you usually get the donor's basis. The most impactful part of this rule, any built-in gain in the property that accumulated during the decedent's lifetime, it's never recognized by the heir. Poof! It essentially vanishes for income tax purposes. This is a massive, massive benefit. It can save beneficiaries substantial amounts in capital gains taxes when they eventually sell the inherited asset. It completely wipes out capital gains tax liability that could have amounted to tens, even hundreds of thousands of dollars if that asset had been sold during the original owner's lifetime.
That is a huge benefit. Can you walk us through an example of this step up? Just to illustrate how much of a difference it can really make.
Let's illustrate this. It really drives the point home. Suppose a decedent died owning a piece of stock. On the date of their death, it had a fair market value of $60,000. Now, this stock had been in their portfolio for a long, long time. Their original cost basis in it was only $20,000. So during their lifetime, there was a $40,000 unrealized gain just sitting there on that stock. $60K value, $20 cost. Okay, now their son inherits his property. Under the step-up rule, the son's basis in that stock immediately becomes $60,000, its fair market value at the date of death, not the decedent's original $20,000 basis. Now, let's say the son then subsequently sells the stock for maybe $55,000. He would actually recognize a loss of $5,000. $55,000 selling price minus his $60,000 stepped-up basis. That initial $40,000 of gain that accumulated during the decedent's lifetime completely vanished for income tax purposes. Gone. This demonstrates the immense power of the step-up in basis. It's a key reason why holding highly appreciated assets until death can be such an effective estate planning tool. Often saves the family a fortune in capital gains tax. Now, there is also some flexibility for the estate itself, which can sometimes impact the heir's basis, although it's less common. If the executor of the estate validly elects it, the fair market value on an alternate valuation date may be used to value all of the estate property, not just one piece. This date is the earlier of either 6 months after the decedent's death or the date the property is actually distributed or sold by the estate. However, this option isn't just a casual choice, it's a strategic move for the estate as a whole. It's only available if its use lowers the entire gross estate value and reduces the overall estate tax liability, if any. So it's a decision driven by potential estate tax savings, not necessarily by trying to manipulate an individual beneficiary's income tax basis. But if this election is made, then the heir's basis for the property will be that alternate valuation date, FMV, not the date of death, FMV.
Okay, so an estate might choose this alternate valuation date if, say, the total value of the estate drops significantly in the 6 months after death to maybe reduce estate tax. But how does that impact the beneficiary's individual gain or loss when they eventually sell?
Precisely. Let's walk through that. Say some inherited property had an FMV of $20,000 at the date of death, but due to a market downturn, 6 months later, it was only worth $15,000. If the executor validly elected the alternate valuation date, because maybe it lowered the overall estate tax liability, then the basis for the beneficiary would become $15,000. Now, if that beneficiary then sells the property later for $25,000, their capital gain would be $10,000. 25K sale, 15K basis. Now compare that to a scenario where the alternate valuation date was not elected. In that case, the basis would have remained $20,000 FMV at death. The gain on that same $25,000 sale would have only been $5,000. 25K sale, 20K basis. So you see, while the alternate valuation date can reduce estate tax for the estate, it can sometimes lead to a higher capital gain for the beneficiary when they eventually sell. It shows how interconnected these tax decisions can be and the need for careful planning. And here's another fantastic advantage for beneficiaries with inherited property. Inherited property is automatically considered to be long-term property. Automatically. Regardless of how long it was actually held by either the decedent or the heir, doesn't matter. This is a huge benefit because it means any capital gains you realize from selling inherited assets will be taxed at the more favorable long-term capital gains rates, even if you sell the asset the day after you inherit it. This completely removes the concern about meeting holding period requirements that apply to assets you purchase or receive as a gift. Makes inherited assets particularly attractive from a capital gains perspective. It's truly one of the most powerful tax advantages out there.
This is great for property you buy, get as a gift, or inherit. Makes sense. But what about those side hustles or home businesses that so many people have now? It's really common. If I start using my personal computer or my existing home office furniture, maybe even my car from a new business, how does that affect its tax basis? It's not like I bought it for the business initially, right? I just started using it that way.
Yeah, this is a really, really common scenario for entrepreneurs and small business owners. And the rules are quite specific, often leading to confusion. The basis for property converted from personal use to business use. It's calculated in a manner that's actually quite similar to gifted property, in that you can have different bases depending on the purpose, one for depreciation, and potentially different ones for gain or loss when you sell it. Okay, so for depreciation purposes, your starting basis is the lesser of two things. Either the property's original cost basis, adjusted for any improvements you made while it was personal property maybe, or its fair market value, FMV, on the exact date you convert it to business use, whichever number is lower. This lesser of rule, again, is applied to prevent taxpayers from depreciating a loss in value that happened while the property was still being used for personal purposes. You can't deduct personal value decline as a business expense. This amount then becomes your depreciable basis, which you'll use to calculate your annual depreciation deductions for the business.
Okay, so let me see if I get this. If my personal laptop cost me $2,000 initially, but by the time I start actually using it for my business, it's only worth, say, $1,200. My depreciation basis is just $1,200, not the original $2,000. Is that right? And what if it's the other way? If it's actually worth more than I paid for it? Say I bought some cool vintage office furniture for $1,500, and now it's raised at $1,800 when I convert it. My depreciation basis would still be the original $1,500 cost.
Precisely. You've got it. Let's use your examples. For the computer equipment that originally cost you $2,000, but had an FMV of only $1,200 when converted, your basis for depreciation is indeed $1,200 because it's the lesser of the original cost, $2K, or the FMV at conversion, $2K. For the office furniture that cost you $1,500 but had an FMV of $1,800 when converted, your depreciation basis would be $1,500, which is the lesser of the original cost, the $5K, or the FMV at conversion, $8K. This distinction is crucial because it directly impacts the amount of depreciation you can claim annually, which, reduces your taxable income each year. Now, when you eventually sell that converted property, the tax basis for determining if there's a gain or loss can be different from that depreciation basis we just figured out. To determine if a gain occurred, you compare the sales price to the adjusted basis at the date of sale. And this adjusted basis is calculated starting from your original cost basis minus any depreciation you've already taken since converting it. If the sales price is higher than that adjusted basis, cost minus depreciation, then that adjusted basis is your basis for calculating the gain.
Okay, so sticking with the office furniture from your example, cost $1,500. I converted it when it was worth $1,800, but we used $1,500 for depreciation. And let's say I've deducted $400 in depreciation since then. If I then sell it for $2,000, how do I calculate my gain? What's my basis?
Good question. Let's walk through it. For that office furniture, your original cost was $1,500. You've deducted $400 in depreciation. So your adjusted basis for gain purposes is $1,100. $1,500 original cost minus $400 depreciation taken. Since you sell it for $2,000, which is greater than your $1,100 adjusted basis, you definitely have a gain. Your basis for calculating that gain is $1,100, resulting in a $900 gain, $2,000 sales price minus $1,100 basis. That $900 would then be a taxable gain for your business. Now, for determining a deductible loss on converted property, it gets a bit more complex again. Similar to the gifted property rules for losses, you first take the lesser of the original adjusted cost basis at the time of conversion, or to fair market value at the date of conversion. Then you reduce that lesser amount by any depreciation deductions you've taken after the conversion. This gives you your specific loss basis. Let's use your computer equipment example again. It cost $2,000 and its FMV at conversion was $1,200. You then use it in your business and deducted $400 in depreciation. If you then sell it for only $500. First, we determine if it's a gain or loss overall. Your adjusted basis for gain purposes would be $1,600. $2,000 original cost minus $400 depreciation. Since the $500 sales price is less than your $1,600 adjusted basis, you definitely have a loss. Okay, now, to calculate the basis for this deductible loss, we take the lesser of $2,000 cost, or $1,200 FMV at conversion. That's $1,200. Then we reduce that $1,200 by the $400 depreciation you took, resulting in an $800 basis specifically for calculating the loss. So your deductible loss would be $300, $800 loss basis minus $500 sales price. Understanding these dual bases, one for depreciation, potentially different ones for gain or loss on sale, is absolutely key to knowing your accurate tax position for converted property. And avoiding a nasty tax pitfall.
We often think of physical property when we talk about assets, buildings, equipment, things you can touch. But what about intangible assets, things you can't touch like patents, copyrights, or even something as abstract as a business's goodwill? How is their basis determined? How do they fit into this whole tax picture?
Oh yeah, intangibles are absolutely vital to many modern businesses, especially, in our increasingly digital and knowledge-based economy. Their basis calculation follows similar principles to tangible property, actually, though with unique aspects because they don't physically wear out in the same way. The initial tax basis of an intangible asset is generally its cost or purchase price, just like a physical asset. This initial basis is then adjusted downward over time, not by depreciation, but by amortization deductions taken on the asset. Amortization is basically the systematic reduction of the value of an intangible asset over its useful life. It's very similar conceptually to how depreciation works for tangible stuff. This is where the cost concept really expands beyond just physical goods. It encompasses the economic value tied up in things like intellectual property or business relationships. Now, there's a special category under the tax code called Section 197, Purchased Intangibles. This is a crucial concept. Congress created this section, Section 197, to sort of standardize how certain acquired business intangibles, like goodwill, are amortized, usually over a 15-year period. When you acquire an entire existing business as a whole, a portion of the lump sum purchase price you paid for that business's assets has to be allocated to the specific Section 197 intangibles. This allocation establishes their basis for that 15-year amortization. This can include things like the valuable goodwill of the business, its reputation, brand recognition, customer loyalty, or something called going concern value, which reflects the value of the business just continuing to operate even without specific identifiable assets. It also covers things like covenants not to compete, where a seller agrees not to open a competing business nearby, and licenses, permits, customer lists, franchises, trademarks, trade names, even existing patents and copyrights that were already owned by the business you bought. All these are crucial assets that contribute to the overall value of an acquired business, and they have a specific tax basis and amortization schedule under Section 197.
And what about the cost of innovation, like research and development, R&D? That seems like a prime area for a business to spend a lot of money without necessarily acquiring a tangible asset right away. How does the tax system treat those investments? Are there any strategic choices businesses can make here for tax savings?
That's a great question, and yes, it offers a direct tax-saving opportunity for many businesses, especially innovative ones. Research and experimental costs. They can be treated in one of two ways. You can either immediately expense them, meaning you deduct them fully in the current year, providing an immediate tax benefit, which is great for cash flow. Or you can choose to capitalize them and amortize them over a period of time, usually 60 months or longer, depending on the rules in effect. The choice here can significantly impact a business's current year tax liability and, again, its cash flow. Now, if a business chooses to capitalize these R&D costs, then any unamortized costs that remain when a patent is eventually obtained from that research, those costs get added to the basis of that patent intangible. This allows the business to then recover those capitalized R&D costs over the life of the patent through amortization. So this strategic choice between immediate expensing and capitalization is a key decision point for businesses investing in innovation. Lets them balance immediate tax savings with longer-term asset building on the balance sheet. Now, for patents and copyrights that are purchased directly, maybe you buy a patent from an inventor, not as part of buying a whole business. Their initial basis is simply their purchase price. Pretty straightforward. For self-created patents and copyrights, maybe you're an independent inventor or an author who gets a copyright. The basis includes the direct costs of development, things like legal fees incurred to secure the patent or copyright, and any government filing fees you paid. However, and this is crucial, a common misconception, the value of the inventor's or author's own time spent creating the patent or copyright is not included in its basis. You can't put a value on your own effort for basis purposes. Only the actual cash outlays for development and securing the rights count. And as we just discussed, research and experimental costs that were capitalized, not immediately expensed, can also be included in the basis of a self-created patent, adding to its amortizable value and allowing for further tax recovery over time. Even seemingly small costs associated with borrowing money can become intangible assets from a tax perspective. It's interesting. For instance, loan closing costs, think loan origination fees, maybe appraisal fees, title search fees. These are generally not immediately deductible when you pay them. They are capitalized as an intangible asset, essentially the cost of obtaining the loan, and then they're amortized over the life of the loan itself. This means you get to deduct a portion of these costs each year over the loan term rather than all at once in the year they're paid. It reflects the long-term nature of the benefit you get from the loan. It ensures a proper matching of expenses with the income generated or facilitated by the borrowed funds over time.
And for new businesses starting up, there are specific rules for getting off the ground. Right? All those initial costs before you even open your doors, they can add up really quickly. And immediate deductions would be a huge help then. Are there specific tax benefits for those early stage expenses?
Absolutely. This is another prime area for significant tax benefits, especially for new ventures that often face heavy expenses before they even generate a dime of revenue. The tax code allows taxpayers to immediately expense the first $5,000 of qualifying business organizational costs and the first $5,000 of qualifying business startup costs, two separate $5 buckets. This provides a significant immediate deduction right when a new business is often in its leanest cash flow period. It's a big help. However, there's an important catch, a potential pitfall if you're not aware. This $5,000 allowance for each item, organizational costs, and startup costs is reduced dollar for dollar when the total cost for that specific category exceeds $50,000. For example, if you incur $52,000 in startup costs, your $5,000 immediate deduction is reduced by $2,000. That's the $52,000 minus the $50,000 threshold. So you only get to expense $3,000 immediately. Any costs beyond these expensing thresholds, or costs incurred if you exceed the phase-out limit entirely, are then capitalized as intangible assets and amortized over a longer period, typically 180 months, which is 15 years. So you still recover the cost, just much more slowly.
Okay, so it's a use it or lose it immediate deduction up to $5,000 for each category, but only if your total costs for that category don't soar too high above $50,000. That makes sense. What exactly qualifies as organizational versus startup costs? It sounds like there could be a lot of gray areas there. Need to get it right.
You're right. It's crucial to distinguish what qualifies and what doesn't. Misclassification is a really common mistake here. Qualifying organizational costs relate specifically to forming and organizing a partnership, LLC, or corporation, the legal structure. This includes things like legal fees for drafting the corporate charter or partnership agreement or LLC operating agreement, accounting fees for setting up the initial books for the entity, filing fees paid to the state to register the entity, costs of organizational meetings. These are directly tied to the legal formation of the business entity itself. However, costs associated with issuing and selling stock or partnership interests, or costs of transferring assets to the corporation, those do not qualify for this immediate expensing. They're treated differently as capital expenditures related to the entity's equity structure. Similarly, for business startup costs, these rules apply whether your business is a sole proprietorship, partnership, or corporation. It's broader. Qualifying costs are those incurred before the business actually begins operations. They're essentially expenses to investigate the feasibility of and then create the business. This includes things like costs for investigating potential markets, products, or business locations. Initial marketing and advertising specifically related to the opening of the business. Costs to secure prospective distributors, suppliers, or customers before opening. Worker hiring and initial training costs before operations commence. Facility and equipment setup costs incurred before opening, however, costs incurred after the business begins operations, like ongoing employee training or routine marketing efforts once you're up and running. Those are typically deductible as regular business expenses in the year incurred, not as amortizable startup costs. Understanding these precise distinctions is crucial for maximizing those immediate deductions for a new venture, which, again, can be a huge cash flow benefit in those early lean years when every single dollar counts. Let's quickly try to illustrate this with a hypothetical. Just to make it clear, imagine ABC Company. They incorporated on June 30th and started business operations on July 1st. Okay? They incurred $14,000 in legal fees for their corporate charter, $10,000 in accounting fees to set up their initial books, and $2,000 in state filing fees. These are all qualifying organizational costs, totaling $26,000. Since that's under $50K, they can expense the first $5,000 immediately and amortize the remaining $21,000 over 180 months. Importantly, let's say they also spent $12,000 on brokerage costs for issuing and selling their initial stock. That $12K does not qualify as an organizational cost for tax expensing or amortization. It reduces the proceeds from the stock sale. Now, for startup costs, let's say they had $24,000 in travel expenses to investigate ideal business locations and $28,000 to recruit and hire their initial team of employees before opening. That totals $52,000 in qualifying startup costs. Since this is over the $50,000 threshold, their immediate $5,000 deduction is reduced by the $2,000 excess, $50K. So they can immediately expense only $3,000 of startup costs. The remaining $49,000, $52K, total $3K expensed must be capitalized and amortized over 180 months. Now, what about the $15,000 they spent training employees after operations began on July 1st? That's not a startup cost. It's just a regular business expense deductible in the current year. This example really shows how precise these definitions are and how easy it could be to misclassify expenses, impacting your current tax write-offs and potentially missing out on valuable immediate deductions.
So the big question then, for businesses small or large, it often comes down to this. Do I capitalize this expense and deduct it slowly over time through depreciation or amortization, or do I just deduct it right away in the current year? What's the general rule? And maybe more importantly, where are the critical strategic opportunities and distinctions that savvy businesses can leverage?
Right. This is a fundamental choice with huge implications for current year taxes, and yeah, it's a constant point of strategic decision-making for businesses. The general rule is actually quite clear. The cost of all tangible and intangible property that has a useful life of more than 1 year must be capitalized. That's the default. This means you record the asset on your books and then recover its cost over its designated useful life through depreciation for tangibles or amortization for intangible. But as with so many tax rules, there are crucial exceptions. And these exceptions are where savvy taxpayers can and should leverage opportunities to their advantage, allowing for immediate expensing instead. These exceptions are really where you find the opportunities for immediate tax savings, a classic distinction, and one that honestly often causes confusion even for experienced business owners, is between repairs and maintenance versus improvements. Repairs are costs you incur simply to maintain property in its normal working condition. They don't significantly add value to the property, they don't extend its useful life beyond what was originally expected, and they don't adapt it for a completely new use. Think of, a simple plumbing repair to fix a leaky faucet. Repainting a room just to keep it looking presentable. Routine servicing of a machine according to the manual. These types of costs are immediately expensed. You get a full deduction in the current year, directly reducing your taxable income. Improvements, on the other hand, are different. An expenditure is considered an improvement if it results in a betterment to the property, meaning it maybe enlarges it, expands it, or significantly increases the quality or capacity of the property, like adding new wing to a building or upgrading a machine so it can perform a totally new function. It could also be classified as an improvement if it substantially extends the useful life of the property well beyond the original expectation, or if it restores the property's value or use after significant deterioration or damage, like a major structural renovation, or if it adapts the property to a new or different use altogether. These types of costs must be capitalized and then depreciated over time. Knowing the precise difference between a repair, expense it now, and an improvement, capitalize and depreciate, can save you from a major audit issue, or maybe from missing out on an immediate deduction that could dramatically lower your current tax bill. It's a critical judgment call.
That distinction makes a lot of sense. So basic upkeep gets an immediate write-off, but anything that truly upgrades or transforms an asset needs to be capitalized.
Got it. What about smaller everyday items, like office supplies? Is there a simpler rule for those? Seems like tracking every pen would be crazy.
Yes, thankfully. There's a simple rule for materials and supplies that really streamlines accounting for all those minor operational expenses. Incidental materials and supplies that cost $200 or less per item, or that are reasonably expected to be consumed in 1 year or less, those are immediately expensed, deducted right away. So think of your office pens, printer paper, toner cartridges, cleaning supplies, light bulbs, all that stuff. These are small ticket items, usually consumed relatively quickly, so you just deduct them immediately when you buy them or use them, depending on your accounting method. This stands in contrast to, say, buying a new server for your network. That clearly has a longer useful life and a higher cost, so it gets capitalized and depreciated over several years. This common sense rule prevents businesses from having to meticulously track and depreciate thousands and thousands of tiny, insignificant items. It saves a lot of hassle.
And there's that special rule for small ticket items. It's become pretty popular among businesses, the de minimis safe harbor, right? This seems like it could be a massive tax saving opportunity if you use it correctly. How exactly does that work? What are its precise limits and conditions?
That's right. And the de minimis safe harbor election is indeed a fantastic provision for businesses. It allows them to elect to immediately expense, deduct low-cost, tangible personal property items for income tax purposes. Provided, and this is important, they have a policy of expensing items below a certain dollar amount for their financial accounting purposes, their regular books and records as well. You need a book policy to use the tax election. It's designed to reduce the administrative burden of tracking and depreciating lots of small assets. Now, the amount you can deduct for each individual item depends crucially on whether the taxpayer has what's called an applicable financial statement, AFS. An AFS generally means an audited financial statement prepared for external reporting purposes, like for shareholders or lenders. It implies a higher level of financial scrutiny. If a taxpayer has an AFS, they can elect to deduct amounts paid for items costing up to $5,000 per individual item or invoice, depending on policy. For a taxpayer without an AFS, maybe a smaller business that just uses internally prepared financials, the allowance under the safe harbor is $2,500 per item or invoice. This distinction recognizes the different levels of financial reporting and accountability. Crucially, and this is the pitfall that many businesses unfortunately overlook or misunderstand, if the cost of an individual item or invoice, per your policy, is more than the allowable amount under the safe harbor, $5K or $2.05K, then the entire cost of that item must be capitalized, not just the excess amount over the limit. This is a really critical point for managing your small asset purchases effectively and strategically reducing your current tax burden. You can't just expense up to the limit and capitalize the rest for items over the threshold. It's an all or nothing rule for each individual item or invoice that exceeds the specific safe harbor limit applicable to you.
Wow, okay, so it's not a partial expensing at all. If one desk costs $5,000 and your limit as a company with an AFS is $5,000, you have to capitalize the whole $5,000, not just the $1 difference. That seems like a really easy way to accidentally miss out on a deduction you thought you could take. Can you give us an example of how this seemingly small detail can have a big financial impact?
You've absolutely nailed the critical nuance there. It's an all or nothing trap if you're not careful. Let's consider a company, CenterCore. They do have an applicable financial statement, AFS, so their de minimis limit for tax is $5,000 per item invoice. And let's say they also have a written accounting policy for their books to expense items costing up to $10,000. That's their internal policy, which is fine for book purposes. During the year, they pay $50,000 for 8 new fancy office desks. Okay. Now, for their financial reporting, their book accounting, they can expense the entire $50,000. Why? Because each desk costs $50,000 divided by 8, which is under their generous $10,000 internal book policy. So on their books, it's an immediate expense. However, for federal tax purposes, despite their financial reporting policy, CenterCore must capitalize all $50,000 for the desk. Unless maybe their economic life was expected to be less than 12 months, then maybe they could argue it falls under the materials and supplies rule, but that's unlikely for desks. Why must they capitalize for tax? Because the de minimis safe harbor election rule is not met here. Since each desk's cost of $6,250 exceeds the specific $5,000 tax limit for taxpayers with an AFS, the entire purchase of all 8 desks must be capitalized for tax purposes. They lose the immediate deduction entirely for this purchase. This highlights how easily you can miss out on an immediate tax deduction and convert it into years and years of slow depreciation if you don't adhere precisely to the specific tax thresholds for the de minimis safe harbor, regardless of your book policy. It's a powerful tool for immediate write-offs, yes, but one with very precise limits you absolutely need to know and follow to leverage its full potential without getting tripped up.
Wow, that was a truly comprehensive deep dive. My head's spinning a little bit in a good way. From the absolute basics of just the purchase price, all the way to the intricate nuances of gifts, inheritances, how you classify an office chair, or even R&D costs for your business. Understanding basis and holding period is truly at the heart of effective tax planning for, well, virtually any asset you own or any business you operate. It's definitely far more intricate than just looking at a price tag or making an educated guess, isn't it?
Indeed, it really is. The key takeaway here, I think, is that the tax rules around assets are incredibly specific. They're meticulously designed to define your starting point for calculating gains and losses. Understanding how that initial basis is formed, not just the direct purchase price, remember, but all the costs to acquire and prepare an asset for use, that's absolutely foundational. Then, knowing how that basis gets adjusted, usually downwards through depreciation as the asset is used. And how different ways of acquiring assets like outright purchase, receiving it as a gift, inheriting it, or converting personal property for business use have distinctly different rules for determining both the basis and the holding period. Knowing all that gives you powerful, actionable insights. It's not just about what you buy or sell, but really how the tax system views its initial value and its journey through your ownership. That directly dictates your eventual tax outcome. It's the very framework within which all your other deductions and gains are calculated. Mastering it is a significant tax-saving opportunity for sure.
And knowing these specific details, like that quirky no-gain-no-loss zone for certain gifted assets, which can actually let you sell without any immediate tax consequence. That's amazing. Or the significant step up in basis for inherited property, which can essentially just erase years of built-in gain and potentially save thousands in taxes. Or even the strategic immediate expensing of startup costs and using that de minimis safe harbor correctly for business purchases. All these can directly impact your tax liability, potentially saving you significant money, or, just as importantly, preventing unwelcome surprises from the IRS. This really isn't just theory, is it? It's directly applicable knowledge for anyone who owns assets or runs a business. Allows you to optimize your financial life through informed decisions.
So as you, our listener, reflect on this deep dive we've taken, what stands out to you? Think about an asset you own right now. Maybe it's your home, maybe a car you use partly for business, maybe even shares of stock you've held for a while. Do you truly know its tax basis and how that specific number impacts your financial picture if you were to sell it today? This deep dive, I hope, reminds us all that the most impactful tax strategies often aren't about finding complex loopholes or some exotic scheme. It's usually about a thorough, maybe even granular understanding of these fundamental rules of basis and holding period. So it raises an important question for you to ponder. What seemingly small detail in your own financial life related to basis could have a massive transformative impact on your tax picture once you fully understand it?
Until next time, keep digging into the details, because that's where the real insights and often the real tax savings lie.